In this video, we'll go through how crypto taxes work in Australia for the 2025 to 26 income year. We'll cover taxable crypto transactions, capital gains, crypto income, records, reporting deadlines, and how to prepare your crypto tax report. This video is for general educational purposes only. Your tax treatment depends on your circumstances, how you use crypto, and whether you are investing or operating a business. Speak with a qualified Australian tax professional if you are unsure. This guide provides a practical overview of Australian crypto tax. We'll look at common taxable events, capital gains and income, investor and business treatment, staking, airdrops, DeFi, record keeping, and preparing your report. Australia's income year does not follow the calendar year. The 2025 to 26 income year started on July 1, 2025 and ended on June 30, 2026. Your report must include transactions from that specific period. If you lodge your own return, it is generally due by October 31, 2026. Registered tax agents may have access to later deadlines, but you normally need to engage the agent before the standard deadline. Australia does not have one special tax rate that applies to all crypto. The treatment depends on how you acquired the asset, why you hold it, what you do with it, and whether your activity is personal investment or business activity. Most ordinary investors deal with capital gains tax. If your activity is organized, commercial, frequent, and carried out as a business, your crypto may instead be treated as trading stock, with profits reported as ordinary business income. Crypto activity commonly falls into two categories. Investment disposals may create capital gains or losses. Business profits, staking rewards, payments for work, and some other rewards may be treated as ordinary income. You do not need to cash out to Australian dollars for tax to apply. Selling, swapping, spending, gifting, or exchanging crypto can all constitute a disposal and trigger a capital gains tax event. When you sell crypto for Australian dollars, compare the proceeds with the asset's cost base. The difference will generally be a capital gain or capital loss if you held the crypto as an investment. Exchanging one crypto asset for another is generally a taxable disposal. When you swap Bitcoin for Ethereum, you dispose of the Bitcoin and acquire Ethereum. You need the Australian dollar market value at the time of the transaction. Using crypto to buy something can also trigger a capital gains tax event. This includes buying products or services, loading certain debit or gift cards, and using crypto to purchase an NFT. Buying crypto with Australian dollars is usually not taxable by itself. Simply holding crypto, even if its value increases, is also not a disposal. However, you need the purchase records for your future cost-based calculation. Transferring crypto between wallets or accounts you control is generally not a disposal because beneficial ownership has not changed. However, both sides of the transfer need to be matched, and any transaction fees should be recorded. Your cost base generally includes what you paid for the crypto in Australian dollars, together with eligible acquisition costs, such as trading or brokerage fees. Each crypto asset and disposal needs adequate transaction-level records. The basic calculation is capital proceeds minus cost base. If the result is positive, you have a capital gain. If it is negative, you may have a capital loss. All values need to be calculated in Australian dollars. Eligible Australian individual investors may generally reduce a capital gain by 50% if they held the particular crypto asset for at least 12 months before the CGT event. Other eligibility rules still apply. Australia does not apply a separate crypto capital gains tax rate. Your net capital gain is generally included in your assessable income and taxed using the income tax rates that apply to your overall situation. Capital losses from crypto can generally offset capital gains from crypto or other capital assets. Unused losses can usually be carried forward, but they cannot normally be deducted directly from salary or other ordinary income. The money value of staking rewards is generally ordinary income when you receive the tokens. That Australian dollar value becomes relevant to their cost base. Selling or swapping the rewards later may create a separate capital gain or loss. Airdrops require careful classification. Many airdropped tokens may be ordinary income when received, while initial allocation airdrops can receive different treatment. Tokens received from a chain split may have a zero cost base, with CGT applying when they are later disposed of. Crypto received for employment or services is generally accessible income. Other rewards may also be income depending on the arrangement. Record the Australian dollar market value when you receive the tokens. Mining treatment depends on whether the activity is a business and on the facts of the arrangement. A mining business may need to report income, account for trading stock, and may be able to claim eligible expenses. GST may also need consideration. The ATO now provides specific guidance on DeFi and wrapped tokens. A capital gains tax event may happen when beneficial ownership changes, including in some lending, liquidity, and wrapping arrangements. The protocol's legal rights and transaction structure matter. NFT tax treatment depends on whether you are investing, trading, creating NFTs, or carrying on a business. Selling or gifting an investment NFT may create a capital gain or loss, while creator and business activity may produce ordinary income and potentially GST obligations. Giving crypto to another person is generally a disposal and may trigger CGT for the giver. Receiving a crypto gift does not normally create a CGT event at that moment, but a later disposal may. Donations to eligible deductible gift recipients can have separate rules. A limited personal use asset exemption can apply in some circumstances. However, crypto held as an investment, a store of value, or with the intention of making a profit will generally not qualify simply because it was eventually spent. You may be able to claim a capital loss for crypto that is genuinely lost or stolen. You will need strong evidence showing ownership, the circumstances of the loss, that recovery is not possible, and how the loss was calculated. Accurate records are essential. Keep dates, times, asset names, amounts, Australian dollar values, fees, wallet addresses, exchange statements, and blockchain transaction IDs. Crypto records generally need to be kept for at least 5 years under the applicable ATO timing rules. Records relating to assets held for several years may need to be retained for longer so that you can support the eventual disposal. Crypto results are included in your annual tax return. Investors generally report capital gains and losses, while staking, payments, or business activity may be reported as income. You can lodge through MyTax or provide the information to a registered tax agent. Start by collecting all exchange and wallet records. Match internal transfers, classify income and taxable disposals, calculate cost bases, review gains and losses, and generate the reports needed for your return or accountant. Crypto Tax Bridge helps you import supported exchange data and transaction CSV files, review your activity, calculate gains and losses, and generate PDF and CSV crypto tax reports. Before filing, check that you selected the correct income year, included every exchange and wallet, matched transfers, verified Australian dollar values, reviewed income, included fees, and exported your final reports. Prepare your Australian crypto tax report with Crypto Tax Bridge. Import your transactions, review your activity, and generate your PDF and CSV reports. The link is in the description.